This is the story of how a viral headline got the numbers completely wrong and why the truth matters more than the mistake. News outlets screamed about China's $688 billion exit from US Treasury bonds, but $688 billion isn't what Beijing dumped, it's what they still hold. The actual figure is $634 billion sold across 12 years, and a massive chunk of those sales happened at brutal losses. Between November 2013 and November 2025, China's holdings collapsed from $1.316 trillion to just $682.6 billion, a 48% plunge that ranks among the most dramatic strategic retreats in modern finance. The kicker? They burned billions in the process. Let's kill the confusion right now, because those $688 billion headlines represent China's current treasury holdings as of October 2025, not the total amount they unloaded. The actual math paints a completely different picture. November 2013 marked China's peak at $1,316 trillion in US Treasury bonds, making them the world's largest foreign creditor to Washington. 12 years later, in November 2025, those holdings had cratered to $682.6 billion, an actual decline of $634 billion, representing a 48% reduction from the top. That November 2025 figure hit China's lowest treasury holdings since September 2008, when they held $618.2 billion, marking a 17-year trough in their dollar exposure. The sell-off came in waves rather than a steady drip. China dumped $173.2 billion in 2022 alone, the single largest annual reduction ever recorded, then followed with another $50.8 billion in 2023 and $57.3 billion in 2024. Just the first 11 months of 2025 saw approximately $78 billion more vanish from their portfolio, and the bleeding hasn't stopped. This gradual withdrawal flipped China's position in global finance on its head. Japan now holds the top spot at $1.2 trillion, and even the United Kingdom surged past China with $877.9 billion, dropping Beijing to third place among foreign treasury holders for the first time since October 2000. A quarter century ago, China ranked third, and they're back there again after briefly dominating the list. Here's where the story gets ugly for Beijing, because they almost certainly ate massive losses on these sales during 2022 and 2023. This isn't speculation, it's just bond math working exactly as advertised. Federal Reserve rate hikes from near zero to 5.25 to 5.50% between 2021 and 2023 created a massacre for anyone holding bonds purchased when yields were low. Picture buying a bond when 10-year Treasury yields sat at 1 to 2%, then watching interest rates rocket to 4 to 5% and your bond's market value crater. You're stuck holding paper that pays 1% interest while new bonds offer 4%, which means nobody wants to buy your bond at face value anymore, and if you need to sell, you're taking a haircut. China crystallized paper losses into real ones by selling during the Fed's tightening cycle. MIT professor of economics emeritus Olivier Blanchard put it bluntly in April 2025, noting that China seems willing to sell US treasuries even if it means absorbing capital losses. Jeffrey's analysis shows that between February 2021 and October 2023, China shed $334.6 billion in holdings, with most of that exodus happening during the most aggressive Fed tightening in 4 decades. That record $173.2 billion sell-off in 2022 coincided with the Fed hiking rates by 425 basis points in 12 months. The $50.8 billion unloaded in 2023 happened with rates parked at their 5.50% peak, and even the $57.3 billion dumped in 2024 occurred with borrowing costs still elevated. China was selling low after buying high, the exact formula every investor spends their career trying to avoid. So why accept these losses? The answer walked onto a battlefield 10,000 miles away in Ukraine. February 2022 brought Western nations freezing roughly $300 billion in Russian central bank reserves as punishment for invading Ukraine, and for Beijing, this wasn't just headlines, it was a template for what could happen to them. The message couldn't have been clearer. Foreign exchange reserves denominated in dollars and other Western currencies could evaporate overnight through political decisions rather than market forces. Your nation's emergency savings, the cushion built up through decades of trade surpluses, could vanish with a policy announcement and some computer keystrokes. For a country sitting on over $3 trillion in reserves, with most of it in dollars, this represented an existential vulnerability. PBOC Governor Pan Gongsheng made Beijing's alarm explicit at the June 2025 Lujiazui Forum, stating that traditional cross-border payment infrastructure can be easily politicized, weaponized, and used as unilateral sanction instruments. Zhang Ming from the Chinese Academy of Social Sciences Institute of Finance and Banking warned in October 2024 that China must address the financial risks associated with possible future sanctions from the US. Former PBOC Monetary Policy Committee member Yu Yongding pushed even harder, advocating for Treasury reductions because of the growing risk of US economic sanctions targeting Chinese financial institutions or China's foreign exchange reserves. The Russian sanctions didn't just shift Chinese rhetoric, they rewired Chinese behavior completely. Starting in November 2022, China began buying gold for 13 straight months, and the sell-off that had been gradual suddenly became systematic and strategic. China's response to sanctions risk arrived on multiple fronts, and every piece shows up in the numbers. Gold came first. The People's Bank of China pushed reserves to 2,305 tons by November 2025, worth $310.6 billion, and gold's share of total reserves jumped from 3.3% at 2021's close to 8.3% by November 2025. Unlike dollars sitting in US banks or treasury bonds that can be frozen with a phone call, gold bars locked in Beijing's vaults stay beyond Western government reach no matter what. Sanctions get announced. The type of treasuries they held changed too, with China increasing short-term treasury bills to the highest proportion since 2009 while prioritizing liquidity over yield. When you need to exit fast, short-term bills move easier than long-term bonds, and Beijing was clearly preparing for the possibility of a rapid withdrawal. Agency mortgage-backed securities absorbed roughly $75 billion annually as China rotated out of treasuries into securities offering about 28 basis points more yield. Not a massive premium, but when you're managing hundreds of billions, the extra return adds up over time. The dollar's share of overall reserves kept shrinking too. US dollar assets dropped from 79% of reserves in 2005 to roughly 58% by 2014, and that slide continued straight through 2025 as Beijing diversified into euros, yen, and other currencies less vulnerable to Washington's political whims. This wasn't panic selling or emotional decision-making. What we're watching is a calculated decade-long strategic retreat designed to slash vulnerability to potential sanctions while keeping enough dollar liquidity on hand to manage the yuan and support international trade. Here's what makes the whole thing fascinating. China unloaded $634 billion over 12 years, including that enormous $173 billion dump in 2022, and the Treasury market barely noticed. The reason comes down to economics working exactly as textbooks predict. Treasury Secretary Scott Bessent cut through the panic in April 2025 with some cold logic, pointing out that if they sell treasuries, then they would have to buy RMBs, and it would strengthen their currency, and they've been doing just the opposite. China can't weaponize treasury sales without shooting their own export sector in the foot through yuan appreciation, which means the so-called nuclear option was never really on the table. Prashant Nunaha from TD Securities noticed something even more telling, observing that if China was selling, then front-end yields should be higher, but they are not. This sell-off in treasuries is primarily at the long end of the curve and speaks to broader investor reallocation. The market was reacting to Fed policy and inflation expectations, not Chinese dumping. Total foreign holdings of US treasuries actually hit record highs at $9.2 trillion in October 2025, even as China pulled back because other buyers stepped into the void without missing a beat. Japan kept its position at $1.2 trillion steady. The United Kingdom vaulted past China in March 2025 with $877.9 billion in holdings, and Belgium's treasury purchases surged 24% in 2024 through channels we'll get to in a minute. Private foreign investors increased holdings by $1.6 trillion over a rolling 12-month period, completely offsetting every dollar of selling by official central banks like China's. Domestic US investors now hold $19.9 trillion in treasuries compared to just $6.9 trillion back in 2015. The sellers found buyers, just different ones than before. But here's where things get murky, because official numbers might dramatically understate China's real treasury exposure by a factor of 2 or more. Brad Setzer from the Council on Foreign Relations points out that treasury securities held through offshore custodians like Belgium's Euroclear and Luxembourg's Clearstream don't show up under China's name in official Treasury international capital data. These custodial arrangements create a massive statistical blind spot that could hide hundreds of billions in continued Chinese exposure. Setzer's analysis suggests that if a simple adjustment is made for treasuries held by offshore custodians like Belgium's Euroclear, China's reported holdings of US assets look to be basically stable at between $1.8 and $1.9 trillion. That's more than double what mainland China reports holding directly, and it would mean the Great Treasury sell-off might actually be a Great Treasury relocation instead. Belgium's holdings jumping 24% in 2024 fits this pattern perfectly, potentially reflecting custodial arrangements rather than Belgian investors suddenly developing an appetite for US government debt. Combining mainland China's $688.7 billion with Hong Kong's $251.2 billion as of October 2025 gets you to roughly $940 billion in reported holdings, still miles below that potential $1.8 to $1.9 trillion total once you factor in the custodial accounts. What this means is, the real story might not be China dumping treasuries at all, but China shifting how and where they park those treasuries to reduce visibility and limit sanctions risk, without actually cutting dollar exposure as much as the headlines suggest. So did China just unload US debt without making any profit? The answer lands worse than that. They likely sold hundreds of billions at brutal losses during 2022 and 2023, when Fed rate hikes crushed bond values across the board. But framing this purely as profit and loss misses the strategic calculation driving every decision. That $634 billion reduction, not the mythical $688 billion, represents a deliberate decade-long withdrawal meant to slash vulnerability to the kind of sanctions that froze Russian reserves overnight. The losses from selling into a rate hiking cycle were simply the price Beijing decided to pay for financial independence from Washington's policy decisions. Selling accelerated hard after February 2022, with China dumping that record $173.2 billion while simultaneously hoarding gold at the fastest pace in decades. By November 2025, they held the lowest treasury levels since September 2008, had dropped to third among foreign holders for the first time in 25 years, and had pushed gold reserves to 8.3% of total holdings from just 3.3% 4 years earlier. Yet treasury markets absorbed every dollar of selling without breaking stride. Foreign holdings hit all-time highs, domestic demand surged to fill the gap, and yields moved based on Fed policy and inflation data rather than Chinese central bank decisions. The apocalyptic scenarios never materialize because economics doesn't care about geopolitics. It cares about supply, demand, and price. The truth sits more complicated than either the bulls or bears want to admit. China is genuinely pulling back from dollar dependence, and they've eaten real losses to make it happen, but they haven't weaponized treasury holdings in any market-disrupting way, and probably still hold massive hidden exposure through offshore custodians that don't show up in official statistics. That $688 billion figure in every headline was never the story worth telling. The real story is $634 billion sold across 12 years, serious losses absorbed as the cost of strategic independence, and an irreversible shift in how the world's second-largest economy relates to the dollar system. Whether you see that as a crisis or just rebalancing depends entirely on whether you think the US Treasury market needs China more than China needs the yield it was getting. Based on what the data shows, the market already answered that question, and the answer is no.